Well, U.S. natural gas futures are trading mostly flat ahead of today's EIA weekly storage report, due at 15:30 Greenwich Mean Time. The market is in wait-and-see mode after Monday's gap lower open, which pushed prices to their lowest level since January 20 following a shift toward warmer weather forecasts. Since then, prices have stabilized for 2 sessions, supported by short-term cold warnings and expectations of tighter inventories. Outside of Monday's sharp sell-off, this week has been relatively calm compared with the high volatility seen last week, with traders largely focused on whether the current storage surplus versus the 5-year average can be meaningfully reduced. The market was positioned for a very large 379 billion cubic feet storage withdrawal, far above the 5-year average draw of 190 billion cubic feet. Instead, the EIA reported a 360 billion cubic feet draw. While still historically strong, the miss versus expectations triggered a brief bearish reaction, pulling prices toward the $3.30 support area. Prices rebounded quickly, however, as bullish traders continue to focus on the potential for another larger than normal withdrawal in the next report. That optimism comes with a clear risk: if the upcoming report also undershoots expectations, the bullish narrative weakens materially. With winter approaching its final phase and U.S. production running at record levels, any remaining storage deficit could be erased quickly, potentially by March or April. Adding to the pressure, weather models continue to point to a broader warming trend by late February. Milder temperatures and reduced heating demand over the next 2 weeks are fundamentally bearish, especially as production recovers. Lower 48 output has already climbed to around 106.6 billion cubic feet per day in early February, up from January levels. From a technical perspective, the daily swing chart shows the main trend remains down. A sustained move below $3.15 would confirm a resumption of the downtrend, while a rally through $4.40 would be required to flip the main trend back to up. The moving average structure is mixed. Holding above the 50-day moving average at $3.40 is supportive, but continued trading below the 200-day moving average at $3.77 keeps the broader tone bearish. In my view, upside potential is likely capped in the $3.77 to $3.90 zone unless the next EIA report shows an exceptionally large draw, above 300 billion cubic feet, or cold weather extends meaningfully beyond February 8. If you found this helpful, consider buying me a coffee or watching ads to support the channel and keep the content coming. Thanks for the support, and I'll see you in the next one.